Okay, our theme song should be pretty obvious. We played it once before, July 14th. Within a day, the market was down 100 some odd points, didn't hold, but I think that's going to be a little different now. Is a correction coming? Absolutely, no question about it. The only questions are when and how low. So a correction to S&P 4,000 is the odds of 3/4 this month. September, it's almost 90%, and by October, 94%. So if you do nothing, at some point your market is going down, and the question is, how much is it going to cost you? 221 is a little difficult because of all the cross currents. It's great for traders, never been better, but for investors, it's pretty difficult because you have to hold your nose. But there are some things that are clear, and those are the things we're going to be talking about. Okay, depending on your views, are the markets going to be higher than 4,500 on close? A lot of analysts are talking around 4,000, which is 10% below. On the upside, occasionally you get a 5,000 person, but usually 46. Oil's pretty much in a range. Gold, we think, is going up, and Bitcoin, we think, is going down. We're going to give you the specifics. We normally take these polls. This is the view of most market bulls, because really you can't look at what's going on. If you looked at what happened in the market on Monday, you had multiple bad news from Afghanistan, from investing, inflation, from consumer sentiment, and the market went to record highs. But that's very typical at the very end of a bull rally. And that's where we are. Whether it's this week, today is one of the critical days, which is why we're having this, or Monday and Tuesday, and we're going to go give you a few more dates when the markets can go down. We know we have inflation. They're allowing 6%. I think 7% is going to be the tough one, but they've even seen 7% in the PPI. And, of course, the taxation, which is going to cover this. So, clearly, a correction is coming. What are the reasons? We know them. Of course, Delta is one of them. Inflation, higher taxation. Market stumbles. Bitcoin collapsing, although that will take a few days for that. Getting back to 2%, which is where we're obviously going on bonds. Most important, having a longer-term perspective, not comparing to last month or last year, but on, say, the 3 to 5 year average. And, of course, the Fed is going to start tapering in September or October, or at least warn about it, or if it doesn't, it loses credibility. We have lots of geopolitical threats. U.S. and China is the big one. So lots of danger. There's always lots of danger in the market, but it's particularly dangerous the closer we get to the October time. So we're not buying, except a few special situations, and we have a lot of bids in the market below. And we're not so sure 4,000 is going to hold, but certainly we're going to get there. So if you look at 10%, it's roughly 32,000 on the Dow, 4,000 on the S&P, NASDAQ 13, but we can go a lot lower. That last numbers are the ones where we were earlier in the year. So there's a lot of possibilities of where we're going. You also look at the 50 and 200-day moving average. But to be buying, except as day traders, of course, at this point, or some special situations, as we have here, you have to be very careful. When will the market reverse? Today may be one of the days, because if the market doesn't go up today after going down, then the idea that you buy every pullback will no longer work. The bonds are definitely going to go back up to 2%, or certainly above 185. The VIX is going to be going higher. Tesla is an interesting one because that's one of the things that when it drops below 555 will upset some people. Bitcoin when it gets below 42,000 again. And finally something like a GME or AMC or Coin or any of it, or Hood, you mention it, any of the Robinhood favorites. So, I think the likely scenario that other people have is stagflation. There'll be some growth, of course, but most of it will be from inflation. So our view is that with Fed accommodation, with the vaccines, the stimulus packages, with the infrastructure schemes, clearly inflation must be protected in your portfolio strongly. And that's something we're going to be recommending and going into some detail later. But to be prepared, I don't think the situation we've had up for the last few months is going to hold. Markets have limited upside. What is the really good news? I don't see it. I understand all the issues, and I'm sure we all do. Now, it may not happen in the last 2 weeks of August because traditionally these are treacherous times for traders. There are always times that fundamentals matter less than usual. However, you should be defensive, raise cash, lower your margin or no margin, write calls, even buy some puts out of the money, hedge. Short-term trading always works, and buy special situations. And we have some here to suggest to you, or to be ready to buy on a pullback. So what we're going to do in just a few moments is I'm going to give you, after my break, I'm going to give you what I consider 3 winning trades that are swing trades. I think each one of them will be a winner, but if they're not, we're going to offer you complimentary admission to our December 21st webinar, so you won't have to pay for it. Okay. So, I'm going to bring up, let's get me my first, one thing I want to say, we have 3 companies presenting. The first will be Acme United, which is a very good long-term play that you don't have to think about, and you'll understand why in a moment. If you know the story about you don't bet on the horse, you bet on the jockey, that's a perfect case for that. And then we have 2 gold and mining situations because in inflation, minerals do well, and these are 2 companies that are ready to be moving. So whether you buy them right now or watch them I think you'll find all 3 will outperform over the next year. So let me bring up our first, and welcome to catch you. Thank you.
Okay. Well, thank you very much for joining me to discuss Acme United. We're one of the leaders in safety solutions and cutting technology. And what that means is first aid products, refills for first aid products, safety items that are related to that. Biggest markets are the industrial and retail markets. We also sell in the cutting area. We're the biggest scissor maker in the world. And when you're the biggest and you do a lot of innovation, it throws off a lot of cash. And it's a very good business because people are opening boxes and FedEx packages all the time. And it's increasing. We've had 11 record years of consecutive sales, and that's really hard to do. We're on our way to our 12th year. We drive a lot of the growth through innovation. Our customer base is a who's who. There's probably not a major retailer or distributor in North America that we're not selling to, and many, many in Europe. We've got a history of successful acquisitions and a balance sheet that's strong enough to be able to take advantage of opportunities as they present themselves. This slide on the bottom shows the traditional cutting area that started with the Westcott scissors and then progressed to Klaus industrial shears, Camilla's knives, food efficient tools, and DMT sharpening tools. On the upper bar, we used to make medical instruments, and those were scalpels and forceps. Got out of that business, but we moved into the private pay area through Physicians Care, which is first aid products that we sell into the office channel. We bought PackKit, an industrial first aid company. That then reinforced with Klaus, which made industrial shears, selling to companies like Grainger and Fastenal and MSC. Very, very powerful combination. We bought then First Aid Only, which is industrial first aid kits, Spill Magic, which makes spill cleanup material. And last year we bought two companies. One was First Aid Central, expanding first aid into Canada, and the second was Med-Nap, which is a very exciting new acquisition. So what Med-Nap is a manufacturer of alcohol prep pads, wipes, disinfectants. It's produced in an FDA facility in the United States. It had about $1 million of Ebitda last year. We've just finished ordering and are almost fully installed with a major increase in capacity, and we're looking to bring in serious U.S. production of alcohol wipes and prep pads. You might know that the state of Florida was our largest customer for a while as we were vaccinating the entire state, and the prep pads we use for the vaccinations. The U.S. Army is another large one. We use these products, of course, in our own first aid kits for cleaning all sorts of wounds. So we're looking to build off this acquisition, and it's an FDA facility, and there's not a lot of U.S. competitors. Our footprint is global. In the United States, you'll see 5 light blue circles. Those are all U.S. production sites. The DMT sharpeners, the Spill Magic spill cleanup kits, the Vancouver, Washington, and Smyrna, Tennessee first aid only kits, the Marlboro, Mass DMT production. All of that 5 years ago, or 7 years ago, didn't exist. And it today is an important part of our diversification away from China into U.S. production. We also have an operation in Germany that services the U.S., the international business in Europe and Africa. It's doing terrifically well, profitable, growing. And in China, we've got 4 offices for quality control, production, shipping. And in Hong Kong, we've got our headquarters for Southeast Asia. Recently, we began hiring in Singapore. We've got the ability to now source outside of China with people on the ground, and that's an important step as well as we diversify our sourcing base. If you looked at our distribution in 2010, it was 59% in the office channel. In 2020, the office was only 17%. And the office channel is defined as Staples, Office Depot, Ascendant, and other companies that are selling directly into offices with specialized facilities. So the reliance on the office has shifted to much less, although not because of sales dropping, it's because the volume of the business increased. Similarly, if you look at e-commerce, it was 1% in 2010. 10 years later, it's 16%, and it's growing very, very quickly. In fact, Amazon is our second largest customer. Our largest, which resides in the mass market, is Walmart. Here's the financial results. So we've grown from $73.3 million in 2011 to $164 million in 2020. And you can see the consistency of growth. For the first half of this year, we grew 11% to $88.4 million, and we're on track for another record year in 2021. The Ebitda has also been growing nicely. $15.3 million in Ebitda in 2020 compared to $5.3 in 2011, almost 5 times. And in the first half of this year, Ebitda was $8.5 million, which, if it was annualized, would be $17 million. Again, another record. The net income was a little bit more spotty, and that primarily related to changes in taxes, particularly when we withdrew about $13 million from our Asian operations and repatriated them into the U.S., used them to pay down debt and build acquisitions. And you may recall that was a period where President Trump had opened up bringing cash back, and you had to pay a tax on it. And that's why there's some fluctuations. In 2021, the first half was up 29%, off the record of $8.1 million in 2020. Again, we're on a track to have a record there. Earnings per share followed the tax differences. $2.31 in 2020 compared to 91 cents in 2011. The first half of this year, up 14% to $1.46. Again, tracking for another record. The dividend, and this is important because I believe in sharing some of the cash flow with our shareholders, who I treat like partners. We are paying 52 cents annually now. It was up from 48 cents in 2020. But if you look back to 2011, you can see that we've doubled during that time period. About every 6 or 7 quarters, assuming the earnings are supporting it and the cash flow, we increase the dividend a penny a quarter. So let's focus on innovation. It's an important part of why we exist, and we're good at it. In this slide, you can see the first aid kit in the upper left. And then around it are modules. Each of those modules expand what we can sell to a customer. So we buy the original first aid kit, then there's an eye wash module, bleeding control, bloodborne pathogen, that's all using spilled magic material to clean up blood and bodily fluids, and of course medications. Each of them part of a system, and picture a company like General Motors or Boeing or Mobil. They're buying hundreds of these in these large facilities and refineries. The Safety Act does something very special. It allows the automatic replenishment of the refills. So while the first aid kit is a very profitable sale, the refills are even more profitable. And if you could capture the refills so that the kits are always filled, they're providing safe ANSI treatment for workers, and you fill them and it's in a proprietary replenishment, then you're capturing a high percentage of the refill business. And it's not just from use of the first aid kits. They expire. They also, frankly, are stolen. And all of that is captured through the Safety Hub. When there's minimum order quantities, these immediately go to a Granger or a Fastenal or an Amazon, which stocks our products and ships it back to the customer. One note you should have is that a typical industrial first aid kit will generate as much as the original selling price in a year with refills as you paid for it originally. So as we build an installed base of more and more of these kits, and we have hundreds of thousands of them installed now, as the refills happen, they keep building on the prior installations. And it's the fastest growing part of our first aid business, and very predictable and high margin. Here's a new eye wash station, and the reason I bring it up is because you saw the box that had a small eye wash station. Well, the customer said, well, some of us get a lot more in our eye than what can be treated with an 8-ounce bottle. So this one is a 16-gallon station, and it's in direct response to our customers in major industries where if you have, like for example, an Exxon, where if you've got something in your eye, you need to flush it in a serious way. And then of course there's an optional alarm and a floor stand. Another new product is in the scissor area, the glide technology. And when you think of a scissor, when you swish it, the part that gives the friction is at the fulcrum. And if you can put a highly smooth finish there and make the tension adjustable, you'll give the customer something that's very, very special. And they're able to use these products not just for cutting paper or cloth, but if you tighten it, it's strong enough to cut cardboard. And so for the delivery area, we're finding a lot of demand here as well as in the craft area. These box cutters are in direct response to our customers that are using our scissors in shipping and distribution centers. It started with a very, very simple one, which had a ceramic blade. You couldn't cut yourself seriously with the blade. It was designed that way. And it competes with a razor, which can very much sever part of a finger or an arm. This particular one is for cutting the top of boxes. The biggest customer is Amazon. We're now in 50 distribution centers at Amazon. It's going chain-wide. The volume today is over $2 million annually and growing at about 60% a year. As you can imagine, products that we're designing into that customer are also very, very transferable into others like Walmart, Home Depot, Target, and so forth. So this product family you'll be hearing more about, but it's generating excellent growth right now and terrific performance. The craft market expansion, this particular planogram is at a major retailer in the United States. It was a multi-million-dollar rollout a year ago, and we're now expanding off of that and adding it to some other major retailers. You can see that you start with a scissors, but then you've got a paper trimmer, a punch, a cutting pad, and cutting tools, all that can be displayed in a planogram at a retailer. Here's a portable battery-operated glue gun. It's a completely new product. It's the first one that is available with real power to be able to melt glue consistently, and it's portable, and of course it's into the craft area. The DMT sharpeners, I mentioned they're made in Marlborough, Massachusetts. These, we believe, are the finest sharpening tools in the world, and they're diamond-based. We have the highest concentration, most consistent diamond dispersion out there. We had a record performance in 2020. We've added another 30% capacity, which is now coming online in July, and we're running very, very well. The margins of DMT are high, and the technology is proprietary. Here's an industrial shear, and it's a titanium carbide. It's the hardest surface that was ever made for cutting. It's almost diamond-like. And initially it's going into the industrial market at places like Grainger, Fastenal, and MSC. But eventually we'll be rolling these into the craft market, into the broad consumer cutting market as the costs come down and we hit volume manufacturing efficiencies. So the growth drivers. Major new products programs going into large industrial, food service, and other distributors. The growing refill business with the safety hub. Again, as we keep putting more and more first aid kits out there, the refill business grows on all the prior installations plus the new ones. The acquisition of First Aid Central to give us Canadian operation with MedNap, FDA facility, vertically integrating us into alcohol prep pads and wipes and other products in the future, expanding product placement of Still Magic, and of course cross-selling into our entire base. The growth drivers for cutting leverage the technologies, whether it's our titanium nitride coatings, our non-stick coatings, which are ceramic and are just, there's nothing like them on the market. Our safety tools with ceramic blades, our antimicrobial plastics for school and office, and of course our new enhanced carbon nitride titanium, which again is starting with the black line in the industrial market and will go further. So as we look at our financial goals, we can drive for solid revenue growth, consistent revenue growth, 11 years to demonstrate. We've been able to do that. 12th year is within sight now. We're driving our e-commerce business, now 16% of sales and continuing to grow. We're developing, of course, the new products that we showed earlier. We've built more inventory because we're working on supply chain risks. And believe me, this is not easy to build in this environment, but we continue to be adding inventory because the uncertainty of shipping and shipping containers and drivers and the trucks, it is just very difficult to maintain the kind of service that our customers expect and we want to deliver. We're driving our ongoing profits. We're reducing debt right now as we look forward to future acquisitions. We've had a history of increasing dividends, as I showed. We went from 26 cents to 52 cents over the past 10 years per year, and we're seeking additional tuck-in acquisitions. One thing I didn't mention is that we had a Paycheck Protection Program loan that was forgiven in June. It was $3.5 million. It's not in these financials, but it's $3.5 million after tax, and that's about 88 cents per share that accrued to all of our shareholders. Thank you very much.
Okay, thank you. So we're going to take some questions and answers. You can do it in a number of ways. You can easily put in the chat. We're going to. You can do that, or you can just go into the chat. I'll start with my question while we're doing this, which is about China. Both where you mentioned it briefly during your talk, but basically over the next 3 to 5 years, how you see your situation changing, and whether or not you see a domestic market in China, because some manufacturers are shifting out of China for their non-Chinese manufacturing situation, but in China using the domestic factories to handle it. And if you could just talk a little bit about that.
Well, in part, the acquisitions we've made have reduced our reliance on China over the past 7 years from about 80% Chinese manufactured to about 40 today. So we've done that. Within certain segments, for example, our Westcott scissors and our Callinex knives, they use Chinese steel, and China is the largest producer with over 50% of the world's capacity of steel, and they're the lowest cost producer. So to move somewhere else puts the product family in a much different cost base. And I anticipate that we'll continue to keep those products in China. And if you were to quantify that, that might be about $60 million of our, say, $185 million this year. So it will continue to decline. We've opened that office, we've hired people now in Singapore, and they're going into Vietnam, Thailand, Malaysia, and India. And we're making progress there. In the first aid area, we've got a lot of products now coming from Egypt. And you might think that's unusual, but when you think about Egyptian linen and fine cottons, it's all because of the big cotton growing area in Egypt. And we've now got a sizable supplier of gauze and bandages coming right from Egypt. So we're expanding it. The other thing that I'd like to cover is the Dalton Road. And that allows Chinese manufacturers to ship out of China, go to a place like Pakistan, which makes medical instruments, take Chinese steel there, and have the processing done where there's not the same kind of labor shortage that China is experiencing. And the wages are lower. So we are looking at utilizing some of the Dalton Road, taking what we need from China out through their Dalton Road, doing the manufacturing, and then shipping from the ports directly. So there's some exciting changes in the sourcing, but I'm confident that we'll be able to meet the needs of our customers and do it with a reasonable approach. Now, relative to selling in China, we don't. And the reason we don't is because when we did it, we found we had sales and we never collected, and there were a lot of samples, so we stopped. And we haven't done that for years, and I don't do it ever again.
Okay. See if there are any. I can't believe who this person. Whoa! If I can get that stopped and blocked. Let me just see if there are any questions. Okay. Well, I think you've said it. The main thing I would like to point out with this company is that it's pretty reasonably recession-proof because of the first aid and the health organization. One of the reasons we liked it, and years ago suggested moving it more in that direction, is the fact that this is one of those things you can sleep at night. People are going to still have to open boxes. People are still going to get hurt. and the profit margins are there, and they're dealing profitably with the manufacturing situation. So to me, it's a core holding you can hold with, depending on your view of the market, whether you want to do it now or wait for a slight correction in the markets. I think it's one you can just sit and forget about. And I'm sure when we have you next year, we'll be seeing that graph going up a little bit higher. So I want to thank you, Walter, for coming. Let me just get everything ready. So for the next, okay, we can see it. Very good. And we can see you. Perfect. So I'd like to present, as I mentioned before, one of the important drivers of dealing with inflation is obviously hard goods. And one of the classic hard goods are obviously mining. It's an area that I've loved for a long time. And I think you have a company here that's just in the right space at the moment to be taking off. So we've been watching it for years, and I think it's about the right time now. So Max, take it away.
Thanks so much for having me. Again, I'm Max Porterfield. I'm President and CEO of Callinex Mines. We're a junior exploration company focused on exploring for and developing base and precious metals-rich VMS deposits, a deposit style, within close proximity to infrastructure across Canada. And we'll go over the various discoveries and what we're up to. I appreciate you having me today. In terms of a bit about the company's history, we're a long-standing company. We actually date back to 1927, when the first publicly traded stocks on the Vancouver Stock Exchange, and had a number of economic discoveries within its portfolio in the Flin Flon district, and we'll be talking about that today. The company was split into two entities in 2011, and then that's what Callinex continues the exploration approach in the long history in the Flin Flon area. We diversified and went east into Canada, where we have got emerging silver discoveries in New Brunswick that we'll go over today, and we're quite excited about where we are in the cycle. In terms of cap structure, we've got 13.14 million shares outstanding, no debt. We recently completed an $8.88 million financing in February of this year, so we've got a strong treasury. And managed to fund a 30,000-meter drilling campaign in the Flin Flon district and a 4,000-meter drilling campaign in New Brunswick in the Bathurst district, which is ongoing. We'll discuss. Collectively at almost 15%, and in terms of institutional shareholders, the largest of which is Resource Capital Fund, been a shareholder since 2015, so a long-standing shareholder of the company, as well as Delbrook out of Vancouver with a large resource. That very quickly is our technical team has been credited with the discovery of 3 of the 4 largest mines in the Flin Flon district's history, as well as numerous others. That's a camp that's produced 32 mines and counting in 100 years of continuous production. One of the members of our team, Mike Mazlewski, is an inductee into the Canadian Mining Hall of Fame, saved the town of Flin Flon in 1982. Jim Piquel was a Bill Dennis Award winner, which is credited for one of the largest discoveries in North America that given year, for the 777 mine that saved the town of Flin Flon in 1993. And Alan Valls won that same award for the Lawler mine, which is a big zinc-dominant mine that's in production in different areas of belt. So again, collectively, they discovered 3 of the 4 largest mines in this camp's history. And while that's so important and what we're up to is the Flin Flon area is in a very, very short time horizon. So as far as the portfolio is, again, we're exploring a big part of the 30,000-meter drilling campaign is focused on Manitoba. We've got silver discoveries in New Brunswick, and then we've got an updated resource coming for gold, copper, zinc in Newfoundland. In terms of Manitoba, as I mentioned, this area has produced a number of mines. You can see how prolific they are, the prevalence with all these black dots being historic past-producing mines, with the exception of the 777 mine that's right there in the town of Flin Flon. And that 777 mine is due to shut down in May of next year. That town is 5,500 people. That employs over 800 people today and forecasted to go to 50 jobs by 2023. And Hud Bay has got very large reclamation liabilities around that. But aside from that, I mean, there's obviously a big pressure for that community, which we're looking to obviously take advantage for our shareholders, but as well as do good for everyone on that town. We're exploring an area called Pine Bay, and this is important as you got to be in the right geology. And at Pine Bay, it's the largest felsic package in the entire Flin Flon district that's been mapped at surface with a very large alteration system. And 90% of all the ore ever mined in Flin Flon's history has been hosted in the felsic rocks, but they only make up 10% of the rock package. So you got to be looking at the felsics, and that alteration system, that's indicative in terms of the size of the volcanic event, because that's what displaced these high-grade deposits is sub-seafloor volcanic activity. So the bigger your alteration system, the bigger your correlating deposit, which is what led previous explorers like Placidome to opine for a 30 million ton exploration target. And 30 million tons would be the second largest discovery outside the original Flin Flon ore body, to kind of give you a scale perspective. So we're located 16 kilometers away as the crow flies from Flin Flon, a 20-minute drive by existing road access. So again, infrastructure and proximity infrastructure is absolutely critical. There's a 5,000 ton per day processing facility in the town of Flin Flon that again is going to be sitting idle in just next year. And the discovery that we've made is called the Rainbow Discovery. It's going to be, and it's shaping up to be right now, one of the top 10 highest grade copper discoveries on the planet. If you look in terms of high-grade copper discoveries, to be in the top 10, you need over 3.75% copper. If you average out what we're hitting so far, we're going to be north of 4, probably closer to 4.25 copper in the intercepts that we've had into the Rainbow today. And it's also ideally located, and it's located within 200 meters of this hydroelectric power line that you see in yellow. So it's clean, low-cost power generation, and the discovery has also been made within a mineral lease that's outlined in orange. So it's advanced permitting. So again, we've got direct road access. We're a 20-minute drive from this community, and we've got one of the highest grade copper discoveries, certainly in North America. And if you look on a global basis, the highest grade copper mines are in Central Africa. So from a geopolitical standpoint, you know, we obviously like where we're at. So we made the discovery by using a different data set, using IP that's not traditionally used in base metal exploration. And you'll see that we were drilling these and then using a borehole system for looking for conductive bodies down those drill holes in these areas, not to get too sciencey. And we were pulsing those holes looking for conductive bodies. And we drilled hole 33 last year, pulsed it, had a very, very conductive source, and followed up, and we hit the discovery hole with PBM 111 as our first hole that we announced just a year ago. August 8th is when we intersected that out there in the field. Since that time, we've been doing consistent step-outs from the Rainbow, and again, hitting exceptionally high grades. I mean, some of the highest grades samples that we've taken from the Rainbow are north of 20% copper. You know, we've got intercepts of 5% of 15% copper. And then we're also announcing much higher grade, wider intervals within the Rainbow deposit. More recently announcing a 67-meter interval that ran, again, 278 copper. And these deposits, while copper dominant, also carry gold, silver, zinc as byproducts, and that's typical for deposits in the Flin Flon district. So again, these are the holes. We've got 2 drills on site that are drilling step outs into the Rainbow discovery, and that's really focused on building tonnage. We will also be drilling and testing other targets along strike. On a regional basis within the area, the reason why it got its name the Rainbow is there's stacked sequencing of historic mines and deposits in this growth fault structure. And this is the pot of copper at the end of the rainbow, so to speak. And so we're very, very excited about the potential of this. And again, we've been drilling at it active. We're in the midst of a 30,000 meter campaign. We've announced roughly 15,000, or less than 15,000 meters of that, so there's going to be a lot of news flow between here and November when we're looking to have that phase of the campaign concluded. We do have an opportunity within the current budget to expand upon that, and so that's a real opportunity and what we're most excited about within the portfolio. Also, in terms of where it sits, there's this main controlling Centennial Mine Horizon, or Rainbow Horizon we call it now, that hosts a number of the Centennial Mine, the Sourdough deposit, and now the Rainbow deposit sits right on that main controlling horizon to the south. So that's really that inflection point of that growth fault to that horizon. And this is just an aerial view. There's a historic head frame on site from the Pine Bay mine, which is sitting right here, which is 1 million tons of 3% copper that exists on site today. Was briefly went into production in the 1960s, and the Rainbow sits right here on that edge of the shoreline there at depth. In terms of drilling, we've traced this deposit from 900 meters vertical depth up to 300 meters vertical depth to date. We've got more holes than this long section is that I'm showing you today. There's much more holes into that. But again, we're delineating this deposit. We're going to be focused on doing that as well as testing high-priority targets along strike on the horizon. In terms of target generation, we've expanded the coverage of IP all the way to the south to encompass that entire trend south of the rainbow, all the way down past the sourdough deposit, which has exploration upside as well, that is open and hasn't been completely drilled out. And now just jumping forward, and I'll take questions on the entire company when I conclude this. We're going to go into New Brunswick. New Brunswick is very similar. You've got a long history of base metals production. The Brunswick number 12 mine that sits right here next to our Headway project was the largest underground zinc mine in the world. It was truly a super giant, well over 100 million tons at Brunswick number 12, and that shut down in 2014 is one of the reasons why zinc prices were propelled from 70 cents up to $1.60 in 2016 during that time. With that being said, we're going to be focusing on Nash Creek, which is in different geology, which Nash Creek is got a zinc deposit, ideally located in proximity to infrastructure, and we've hit silver discoveries along this trend. So Nash Creek itself, again, sits 25 kilometers away from the rail line power station. This is a coal-fired plant, but again, low-cost power. There's a deep water port that gives you direct access to market, as well as a lead smelter that's due to shut down. And that's another thing in terms of poverty, and in terms of high unemployment rate in New Brunswick. New Brunswick is the poorest province in Canada. Pre-pandemic and prior to announcing this lead smelter was going to shut down, which accounts for 80% of the jobs in Beldoon, there was a 23% unemployment rate. So again, very, very high unemployment rate, well over 20% still to date. And we think that, well, obviously, we've gotten a lot of support from the community to that end because of the potential. The PEA that we published here forecasts a job creation of 225 direct jobs. So again, we're within 25 kilometers along the provincial highway, and there's the transmission line runs adjacent and through the Nash Creek property. Nash Creek is a 19.1 million ton resource. This is a zinc lead deposit that's flat lying and near surface, so it's amenable to an open pit operation. A large majority, almost 80% of the world zinc production is underground. It's very unique that you get a flat lying near surface open pittable deposit. We published a maiden PEA on the property in 2018 that showed a pre-production capex of 168 million. So on the low end of the capex curve, again, being a open pittable deposit in proximity to all this infrastructure was critical to that end, not being so remote. Less than 3-year payback, $230 million pre-tax NPV, and a 34% pre-tax IRR. And that was, again, a quick snapshot because when we acquired Nash Creek, it was a 9 million ton resource, and then we used a historic IP survey and doubled it to 19.1 million tons. And so that was, again, just a preliminary study to see where do we need to go from here to further improve economics. And that's what led us to broadening and doing a much larger district-scale IP survey over the area and drill testing that, looking for more near-surface mineralization and higher grades. And that's when we were very excited that we hit silver. So it's silver dominant as the two discoveries that we hit along strike from Nash Creek on a main controlling fault. NT 2313 hit 16.5 meters and 95 grams per ton silver within a broader interval of 28 meters and 57 grams per ton silver. The cutoff grade based on the PEA is roughly 40 gram per ton silver equivalent. So again, this is above cutoff grade, shallow mineralization, and it's all tying together. The second hole that we intersected was the 306 discovery hole. This was 6.8 kilometers to the south on this main controlling fault. 306 at 19 meters of 37 gram per ton silver, included 0.4 zinc as well and 0.5% lead, so you have more of the base metals in this hole. And that was 3 meters of 130 grams per ton, so higher grade interval within that right near surface, within 20 meters of surface. So we followed up from that and we did a soil sampling campaign. And you can see the anomalous silver that came from that, so the soils and how it's correlated with the fault and the IP isoshells. And the drill data, the discovery hole 313, as well as 306 was colored too far off to the west. It was a vertical hole there. So we're in the midst of a 4,000 meter campaign. It'd be 15 targets to test the extent of that entire 10-kilometer trend between the two silver discoveries, and that would put us on a path to building a near-surface silver-dominant resource to build upon the 20 million tons that we've already have at Nash Creek proper. Again, also to the east of Nash Creek, we've got the Central Zone area, over 1 kilometer strike. We've hit summer grades and stacked sequencing of Nash Creek, and that's an opportunity to further build upon the near-surface base metal style mineralization out there at Nash Creek in the future. About a dozen drill holes will likely get us an inferred resource there at the Central Zone area. But again, we're really prioritizing what we're doing with the silver discoveries along that main controlling trend. And just to wrap things up in Newfoundland, we've got the Point Leamington deposit. Point Leamington is a historic resource grading 14 million tons, over 1 gram per ton gold, 1.9% zinc, almost 0.5% copper. So it's truly a gold-dominant VMS system. We were doing a review of the historic resource, and it had been modeled actually as an underground resource, and we believe that it really should be an open-pittable deposit, which changes a lot of different things within the deposit. So the deficiencies were getting updated. We're doing a sampling of historic core, 15%, and that'll culminate into an updated resource in the very near future at Point Leamington. Point Leamington also sits within a mineral lease, just like Pine Bay does in Manitoba, so it's advanced permitting. And on a regional basis, we've staked regional airborne targets that we like and excellent geology that we ground truthing and building into the exploration pipeline. But we've got a great head start with that historic resource that we'll bring up to modern day compliance. And again, this is a deposit that was held by Noranda for over 30 years, and they sold it and divested at $200 ounce gold. So we're looking to go potentially north of a 1 million ounce gold equivalent would be an ideal scenario at Point Leamington on this maiden resource there from a 43-101 compliance standpoint. So to that end, I'd be happy to take any questions on the company. I do believe that we encompass everything that makes a great exploration company. We've got a tight cap structure. We're capitalized, a strong portfolio of emerging high-grade discoveries, particularly highlighted by the Rainbow discovery in Manitoba, and a technical team that's done it many times over. So with that, I'll take any questions from the audience.
Okay, you can do it by putting in the chat if you like, or raise your hands. Either way, I will open it up for that moment. Put it into Q&A. I have 2 questions. What would, if we were hearing this presentation next year, what sort of differences, and everything goes the way you expect it to go, what might be here, and also would it require a financing between now and then that we have to look out for?
In terms of a financing, I believe that the structure is in place to where we can kind of self-financing through some of the warrants, but there would be likely to be a financing at some point. Certainly not in the near to medium term, I wouldn't call it. In terms of the warrants I'd mentioned, there are we get $6 million from a warrant exercise at $6 a share, and I do believe that as we continue to de-risk the deposits and we can really execute on probably taking those down from our shareholder base. In terms of where we like to see ourselves in 12 months' time, I'd like to see the Rainbow deposit to continue to grow, and then obviously be done with consistent step-outs. And we'd like to make another sister discovery on the Rainbow horizon. And I don't want to be too greedy, so I'll say we'll have another one of those, and then be delineating that resource. And then, at one point or another, we'll look to have a maiden resource there in Manitoba. In terms of New Brunswick, I'd like to, in the current drilling campaign, obviously expand the discoveries and show consistency along that trend and a path to build a significant near-surface silver resource. Because, again, it'd be really unique to have a near-surface silver resource in Canada, ideally located adjacent to what's already shown to have a positive economic deposit at Nash Creek. And then in Point Leamington, I'd like to get that updated resource obviously published, prioritize the drill targets, and kind of reduce them from maybe a dozen to 6, and then test them and hit. That's where I like to see us in 12 months.
Okay, and then just one other question in case no one else has. Assuming one's not somewhat of a bull as I am on some of the minerals, and the prices stay the way they are now, how does that,
listen, I'm excited about it either way. Again, the economics, when we looked at Nash Creek originally, silver prices weren't at where I think silver prices are poised to perform and where they've kind of leveled out to be, much higher than we were 12 months ago. in terms of the copper markets, to say you're in a $4 copper territory, I think everyone's getting greedy to ask for anything more. I mean, do I think copper is going to move higher? Certainly I do. But at the same time, am I ecstatic at $4 copper? Absolutely. If you look at the Nash Creek deposit, when we published the PEA, again, it's kind of ill timing because we did it when zinc was at $1.60. We did a base case at $1.25 zinc, and we announced it 2 weeks before the trade war that's, sent zinc's prices spiraling down to 90 cents within 3.5 months. Today, you've got $1.35, $1.40 zinc, and, I think the industry overall should be very, very happy with those price environment that we're currently in, and not always, so focused on relying on higher prices as a mechanism for share price performance.
Absolutely, and that's one of the things I wanted to point out, because clearly anywhere near the current thing is super good.
Yeah, okay. and also it's really unique having the type of discoveries that we're having. I mean, to say that, I was pleasantly surprised with the grades and how they're panning out. It's certainly a rainbow.
Okay. I don't see anyone doing that, but I think it's a good presentation. We'll be posting it online for those who want to review it, and it's certainly something you should be watching in the mineral space. So I want to thank you for presenting, and we'll be posting it next week for everyone to catch it. So I'm going to take you down as a moment from, let's get this out of the way. All right, first of all, we promised you 3 winning trades. So let's start with that, and we've got a whole bunch of material to cover in the markets. Okay. First of all, bonds. In my mind, there's no question, despite the fact that when markets come down, bonds are going to move. Within the next 2 weeks, we think they're going to make their move up closer to 140 to 150 in the old range. So while we did a short at 125, it could come down as low as 120, even 118 is a possibility if you wanted to do 3 trades. But it's almost definite. I mean, it's a 90% trade. It's going to be going to 175 to 2 before the end of the year. So that's, to me, a no-brainer trade. The next is, whether the markets come down today or not, when we hit the fall equinox, there are 2-3 days in a row that are extremely negative. They're red alert. Today we're on a watch. Monday and Tuesday are a yellow alert. But when we get to the 21st, 22nd, 23rd, it's going to be a sell-off. So you've got the maximum time you've got is about a month to 4 days. It may be starting today. It may be starting next week. It may be our third time, but the markets are going down, not up. And then the third trade is silver, which goes back and forth with gold because it's also an economic metal and therefore gets hit. By the time we hit mid to late November, silver is going to be flying for a couple of weeks or 2 or 3. So we want to be taking silver. If it holds the 23 level, you want to have it. Basically, anything below 25 is a good long-term buy here. We'll be going back to 27. So these are 3 winning trades that we think are just no-brainers. I think there's 90% chance of them. So again, sell bonds, be selling the S&Ps. We could be doing it today. We can be doing it Monday and Tuesday, and we'll give you some other dates, and then to buy silver in the November rally. Whoop. Why is this not moving? What is going on here? Okay. Let me just move forward. Get back up. Okay. The only important part of the gold view that we want to discuss is the fact that some computer programs are set that whenever there's inflation, it sells gold. Now, everybody that owns gold has it because it's an inflation driver. So these are non-traditional gold traders. These are hedge funds and computer programs. At some point and some days that switches, and it will switch, most definitely. But at the moment, sometimes when you see inflation, gold's being sold, which is crazy. The other point is Bitcoin. When Bitcoin comes way down, that means below 30,000 and the 28,000 at the beginning of the year, then some of those people will generate and go into gold, because some of the reasons people are in Bitcoin are the same reason people traditionally would be in gold. Obviously, it's not the case at the moment, but that's another big source of investors. Gold has started its seasonal favorable cycle. We saw a test of 1675. that held very nicely. It's currently worth about 1836, has 1750 support, 1780 temporary support, and its fair value shortly will be about 1840. So we've got a ways to go. It's an undervalued asset. Excuse me. If you look here, as a commodity, a currency, an inflation metal, and a crisis metal, we're going to be staying long gold, both as an investment, generally speaking, a trade, and a portfolio hedge. Silver is worth about 27. It has support around 23, 24, but overhead resistance at 30. So overall, these are good things to buy. If you want to hold on to a lot of stocks in the market, these are good hedges, but many of them, including the companies that we were showing, although we didn't get to show you Vista, you should take a look at it. We'll try to place it as soon as we can, are going to be good long-term situations. So our commodity trading is we always buy gold on dips. We rinse and repeat it. We had several trades that we've closed. We're currently long at 1763 and 1754. Winning trades. Silver is the only one that's underwater because we bought at 24, 25, and 24 again, but we're holding it because we think it's going to go back up to 27. If it does go break 23, we'll take a loss on one, just simply for money management. Copper may be testing. It's in a range of 410 to 450. We've broken 420 and 410 support, and 4 is pretty strong. So once we get down there, there'll be new buyers if we get down there. And finally, oil has a bunch of mixed things. 66 is a temporary pivot. 60 is a long-term support level. But for us, every time it got above the 70s, we want to sell it. So if it goes back up to 72, 74, we'll be selling it. If it goes back to 60, we'll be buying it. Inside here, we've got a lot of mixed factors, so it's good for very short-term trading. And the question is whether 66 holds. 60 probably will hold. That's the long-term support. Pivots for the market. We've discussed a little bit. We have a lot of trades, some of which are slightly underwater. We just started with the bonds at 125 to short them, but the markets themselves, and especially NASDAQ, if you only had to do one set of shorts and you didn't want to short the S&P and you didn't want to short the Dow, short the NASDAQ, because there is a trade of people moving in and out of momentum and into value. So you could also do sell NASDAQ, buy Dow, sell NASDAQ, buy S&P, although I'd rather just be short all of them. We've talked how markets are different primarily because of computers and because of newbies. Lots of reasons. This screen is sort of obvious. You could come up with lots of reasons to be long the market. You can come up with lots of reasons to be short the market, and it just depends on what day something has a value. The ones that are going to be coming new is the U.S.-China's trade spot, which in fourth quarter is going to be very serious. So you've got to watch out for that. And of course, the Fed has to start moving somewhere in September and October. In addition to which, you always have the annual October crash correction, whether it be in August, September, October. So all those things are help the short side. This is the big astrology picture that things are changing. We've dealt with that at the beginning of the year, so we don't want to talk about that now. Some key dates are going to be in December, so we don't have to worry about it. But the short-term ones, take a look at. Today is a key date. If the markets come down, they're probably going to stay down. But if not, they're going to get hit on the 23rd and 24th. And if not, you'll see in red, September 22nd to 24th. You've got to have protection then. Right now it's yellow alert, but that's red alert. And the other dates you want to look at is the CPI, which I think is going to show to 7% on the 14th of September. And then the FOMC has to say something, and people have to start to move. Gold is generally positive. Oil is sort of positive, but it's above the range we like. Bonds are way out of whack, and China's going to be in trouble. That is to say, is going to be much more aggressive. So these are increasing risks to market ownership. The technicals are pretty obvious. Dow 35,000, S&P 4,500, NASDAQ 14,800, Gold's in a trading range, silver's in a trading range, although it's below the trading range now. Oil, the 66 level, which can be replaced by either 60 or 70 if you're traders. Copper has pretty strong resistance at 450 and is going to test the low side. Bonds are definitely out of whack, and Bitcoin's a little expensive here, but can easily drop. Not important, not important. Most things are not valued appropriately. Gold is undervalued, silver is undervalued, S&P is overvalued. Oil's sort of okay, but a little expensive. Bitcoin is definitely expensive. By the way, I just saw an interesting report that says that they have a 3,000 target for Bitcoin, because again, at some point it's going to be illegal. Right now it's illegal in China, it's illegal in Turkey, it's illegal in India, but the U.S. investment banks are trying to make money on it. But once the central banks get into having their own digital money, they're just going to stop it. First by taxing it, and then by stopping it. And of course, U.S. bonds are just way out of whack. So what are the overall things? Because I'll take some questions. Distressed investing, there's going to be a lot more. M&A, there's going to be a lot more. Day trading couldn't be better. We've had a short bias from July into August. So that's generally working, but sometimes it only works for a day, but it generally is working. You have to watch out what happens at 10 o'clock, because most of the time the market goes down and then people buy every dip. That didn't work yesterday. It's certainly not going to work on next week, but it may work and hold. We don't know. Safe haven income is good. Water utilities, tips, corporate bonds, select REITs, and of course gold and commodities. Precious space, battery, some energy, clean energy does well. Entertainment we love. Safety and cybersecurity, unfortunately, will continue to be very strong. And the technology of IoT and space travel, which has been a theme for the year. The new one we're going to be adding next year, because everything else you've seen, is ag tech. Because agricultural technology, using water farms and city farms are going to come up over big next year. To be cat-like, copper did well, but I think it's overvalued, but long term it will do well, but it's got cross currents. Inflation is here. Precious metals are inflation hedges, despite what computers think. It's just a question of when they wake up. So there's a summary, and I'm going to give a few examples, which you can put on your screen. Stock picking, I think, is going to certainly outdo investment, index investing, and it has been so far. Use stops. If you're trading, you got to take profits quickly, but not necessarily all of them. And we're rotating from this has changed now, because we went from a quarantine to recovery, and now we're going back to quarantine, and then we're going back to recovery. So that hasn't been updated. So that's going to change. And again, they're not easy to forecast. You either have to take a very long-term view for 222, or you've got to take a very short-term one, as we do. We do both. We want a maximum allocation of the commodities. Stock selection is important, but you're never wrong taking a company like Acme, which sports strong cash flows, sound balance sheets, and growing dividends, which is why we presented them earlier. And again, we think we'll be outperforming index funds a lot. This is a repetition of what we have here, even things of art and blue chip collectibles for those who like it. Now, in our space, there are just so many picks. I'm going to just put a few up on the screen, and you can catch it on the video later if you want to have it. There's about 5 companies. We have just too many companies, many companies we like in the gold space, in the big cap space, or actually mid cap space. There's a group we like there. We have a whole bunch. Again, we can post this or take a screenshot of what we like. But in general, most stocks short-term will do well in the space. Again, silver, they'll do very nicely by November. You want to have your silver exposure by November. And again, your copper exposure and base metal exposure, such as Callinex, which gives you a nice choice. Lithium, we like Obviously, it's done well. It's going to do well, and that's clearly a 222 picture for us, as well as clean air metals. Also will be doing well as part of the clean energy, but they'll get hit short term, I think, with the correction that's coming, but then you want to have some you want to buy. Entertainment, we love, of course, because whether markets go way up or way down, people want to be entertained. Some of them are expensive. And then I have 4 defensive picks. You may want, Acme was one of them, Global Self-Storage, Manhattan Bridge Capital, and Stag Industrial are all companies that will do well even in a bad environment. So there's something there you can take a look at, whether for now or when the market's correct. Rare earths are something for us more for next year, although you can pick up some bargains now. Healthcare, we have 5 that we like at the moment, but many are on watch. Ebitda, Celsi, which, by the way, we waited for the correction. We like it here. When it went way up, we recommended selling some of it. Cytosorbents, Diagnose, and Arch Therapeutics. And then there's a whole bunch of other stocks that I'm sure you have your favorite ones that will do well. We're adding some things to energy and distressed, although we felt when we got to 74, we eliminated a lot of conventional energy. We may be buying it back again if markets go down 20, 25%. Remember, they may go down 10%. They may go down 15%. They may go 25 to 30, depending on which of the phenomena we have. Special situations always. So everyone should review their portfolio holdings. If you want to hold long-term and don't care, most people think we're going to go 4,000 before 5,000. I'm a believer in that. So have a list of stocks to buy after a correction and have the cash to do it. Bid for it. And then certainly have investments that benefit from higher inflation. Gold, utilities, art, selective real estate. They're going to benefit, and it's not temporary. Yeah, lumber went up 300%, and now it's up 150%. So if it stays up 100%, I don't consider that temporary. I know someone who was building a house. They were starting to do it. The estimate was 375, and then it went to 650. They're waiting to continue it. It's going to be 450 now. That's serious inflation, and you're going to also see it in the rental income. So I want to take some questions and answers. Before I do, I want to point out we have a number of events that hopefully will be live in New York. September 22nd, which, because of what's happening in the city, may turn into a webinar. October 14th and the 17th, but the talks are important because we're big gold players, and the 3 big drivers of gold and commodities are, 1, the China, so we're having a talk on China. The second is oil, so we're having a good talk on oil. And the third is Forex, because that's very important. So China, oil, and Forex have to be watched for commodities.